Hello everybody, it's March 29th, 2015. I am back in the office after a week of personal duties that I had to take care of. So we'll kind of be getting back to normal here in terms of materials and so forth. Last week was a tough week, another 2% down. Those wild, woolly, if we will, gyrations look as if they're going to continue. So, and unfortunately, I didn't pay enough respect to that possibility. So 2.5, 2.7 down to 2 across the board. You're back negative on the Dow, barely in the positive on the S&P, 3% on the Russell and the composite. So another big week of straight moves. In this case, straight down. And if we look at the S&P 500, you can see how that move, just as we've seen before, just gathered steam and day after day just worked its way lower. Monday, Tuesday, Wednesday, Thursday, and Friday. Each day just straight down. All you did was get some consolidation on Friday after, another 2% move back to the downside. So another week of volatility. We've seen this before. I had mentioned this, I believe, last week, that this volatility that we've seen was probably going to continue, right? And so we had this up and down action. Finally got a smaller retrace that led to another breakout, pull back into that area, spike back up to the top, back down, right? Every week it seems it's one or the other, right? It's either straight down or straight up. And I suspect, we're going to have to realize this is what's going to happen. And when we get to the portfolio, we'll see breakouts just are not working. Breakouts for the last 3 years have worked over and over, time and time again. They're not working anymore. I mean, take this breakout, for example. What was it good for? Maybe 1.5%, and then you're back down underneath it. It's just not working. And that's true here on the index, is also true on a lot of these individual stocks. So we're going to have to just realize that, and we're going to have to factor that in with respect to what we try to do. Let's do a quick review here. Last week the Fed bump higher was totally taken away, and what you're going to see on these weekly bars is takeaway bars. A complete takeaway of the prior week's goodness, right? And that's never a good thing when you get that kind of action. Like here, for example, it was a takeaway of the bad. You get a little bump up. Then here again, a takeaway of the bad, you get a bump up. Well, here you get a takeaway of the good. I expect you're going to get a bump down. That's the expectation. That's what should happen. We'll have to see if it plays out that way, but it's certainly not the kind of situation that makes me want to get all excited about getting along again as a result of that. If I go back to the daily chart here, one of the other things that we have to realize is that this is probably the third time now that we've seen ABCD structures fail. Remember, we had an ABCD structure here that projected up until this price range. We didn't get there. We came back down. It held at about that same level, tried to go back up, didn't even get to the high again. So again, that ABCD structure just can't make it. And when we look at it on the weekly time frame, we've got the same situation on the weekly time frame, where those ABCD structures that look like they're set up to make the runs, they simply can't get to the levels that they're trying to. So if we take this one back down, right, it just can't get going. Every time it gets up there, it fails. And this is probably not the best example of it, but we could look elsewhere, like at some of the other indexes, some of the individual sectors, and that's what we keep seeing, is we keep seeing failures on attempts to finish off ABCD structures. When I see failures over and over again, right after we've had a long run higher where everything almost always finished up its structure, it's just another reminder to us that this is not the same market. This year is not the same as the last two or three. and we can't expect it to do that. Last week I got lulled into it, or actually last Friday a week ago, and said to myself, okay, it is going to try to break, it is going to try to finish off those ABCD structures. Not to be, right? We simply bought at the worst possible point and ended up losing as a result of it. And if we're going to make money this year, we can't do that. We're going to have to buy retraces. We're going to have to sell extensions, period, until this market character changes. And right now, I see no change in that character. The dollar, it pulled back a little bit more. Nothing major, but there was a continuation of some of that pullback. If we look at that chart, you can see, Monday it pulls back and then it held steady the rest of the week. So a little bit more down on the dollar, building out a larger range now. In this case now we've got the dollar this wide on the range. If you take and extend that, it's not that much farther down here. Actually, if we extend it completely to kind of match that one, it would be back down into these bottoms. So it's kind of holding this breakout area. It hasn't quite gotten into those highs. We had some pretty good volume off the bottom, right, with this particular bar back up. We had big volume as we came down. The dollar at best is caught in some sort of a range. Again, I don't know if that range is quite done. If we extend like we did before and we say, okay, we've got a range here, a range there, and potentially one back underneath it into that lows right here, then those three ranges, you can see, if you look at it from that perspective, right, we're sitting basically inside that second or the middle range, trying to test to get back up. The bar to get back up into now are these two big bars, and these are kind of the test on the dollar. If the dollar's going higher, it's going to have to get back inside these two bars. That's that lower range you see right there, that lower resistance zone. That's where it's testing now. If we get back up into here, then certainly, the target would be back up here again. Dollar pressure has been an issue because everybody finally recognizes, although, we talked about this last summer, everybody's starting to recognize that the dollar is a problem, or at least an excuse for corporations with respect to their earnings. And earnings season is coming up in a couple of weeks, and that's going to be something to continue to watch here. So the dollar still in issues. When the dollar works lower, of course, commodities tend to work the other way. And if we go back and we take a look at some of those, we can see here, like on the continuous commodity index, the GCC, the spike up, holds up there. We can see it in the gold market where it spiked up this past week. Basically 5 days of pretty much up and across. If we look at oil, for example, and now oil is geopolitical as well, but let me grab the oil chart. And on oil, you can see the same sort of thing here where, let me get the oil chart, hang on a second. Here we go. You can see that spike up, of course, big sell down Friday. Oil still has all the problems it had. It's just that oil had gotten so oversold, and I was trying to trade this on that retest region, and I'm sure if any of you took that, you certainly are aware of it. Trying to trade it off this retest region in this area, and then got blown away and stopped out here. These markets continue to be kind of like, anything that trades horrible the week before, you want to buy it. Anything that trades well, you want to sell it. And that's what happens when you sit there and you look at, the S&P or any of these major indexes, and we look at them from the perspective of that gyration that I was pointing out a while ago, where everything is just spiking back and forth, and it's week to week. It's almost, almost all of these are week to week. If you go back and count them, and I think we've probably done this before, but it's like 5 days almost. This one was, started up here as 5 days down, you get 3 days up, you get 5 days down, you get 5 days up, you get basically 6-7 days down, 5 days up, so forth, right? It's almost a week at a time, and it's like they get going in one direction each week, and they just keep going. If that pattern were to play out, of course, you would expect this thing to go straight back up this week. Just like we saw here, though, a pause that then continues, we could be facing some sort of situation like that. In other words, a pause here that continues and gets us down into here. And I want to take just a second and talk about that before we go any farther. So far, the market direction, if we look at it from a longer term perspective, right, continues to be up. And what I mean by that is if I pull the weekly up, you can't argue that this thing isn't going this direction. Yeah, it's had some big spills, right? But in general, this thing still continues to make higher highs over and over and over. It's having a tough time now. Did not make a higher high this particular week on this particular index, but it has pretty much everywhere else. And if we extend it and go to the monthly, you can't argue with this trend whatsoever, right? It's continually going higher. So longer term, this thing still shows a higher trend, and you have to respect that it's a higher trend. In other words, you can't get so bearish because it's got all this gyration. On the second thought, though, with that gyration, the easiness of how it was before, where you just bought anywhere and you got bailed out, it doesn't feel that way anymore, right? Buying anywhere doesn't just get bailed out anymore. And the risk is that after such a long run, with all the issues that are out there, despite the central bank's intervention, we are coming to what looks to be a different feel to this market. And that's what I keep saying about this year is not like the last 2 or 3. I don't think we can just buy and assume the market's going to bail us out anymore. As a matter of fact, the risk is that the market doesn't bail us out, and that instead that ABCD structure I was just showing you, potentially, the little one here on the daily, could take us back down here to visit these swing point lows again. Folks, when we break these swing point lows, if and when that comes, it's going to be major. It's going to take us all the way down and threaten on longer term time frames. And I'm talking about the long-term time frame. Because if I go back to that long-term time frame, this is about to set up as a swing point low. We've already got 5 bars. It only takes 1 more month, this month and next. So we're about to start April, so this one's about to print. That's going to be 5. If you get through April and you don't break this low, you're going to have 2 swing point lows that are located very close to each other. They're not going to be that far away when you talk about this time frame. You're also going to have multiple swing point lows here and here on the weekly. So in other words, a break of this level is going to push back to get you back down here to test this level. That's going to be an issue if it happens that way. I talked about this early this year, that we could set up by the time we get to about May, June, that we could have some very dangerous, potentially dangerous situations setting up in the market. And we're not that far away now. We're only, a month and a half, 2 months away. If this market does not change its character over the next month or 2, it's going to get much more dangerous. And so it's something we can't forget. I'll do my best and my part to keep bringing it to our attention, but it's something we have to recognize. And with these change of structure, right, where these bullish structures are not fulfilling, that's a problem. Takeaway bars. We've got enough sectors now also showing us issues. Let me show you that right quick. So if I pull up the general market, indexes and the major sectors, you can see that we're starting to get some real, bearishness start to play out in a number of these. So we've got it here, we've got it there, here, and if we go a little bit farther down, yeah, we've got it in those 2. So utilities, and we take that back off. We've got it 1, 2, 3, right? 3 of them bearish. 1, 2, 3, 4 now sideways. 1 bearish on the indexes. one sideways on the indexes. It's not going to take that much more, and usually, as I've told you before, once you get two or three that transition to the same, lower or higher trend, you typically get the rest of them to follow. And so my concern here is that because we've got these bearishness ones, enough of them now, there's three, these others are all sideways. These are not that far away from going the same direction. And if that's the case, which generally is the way it works, then we probably got more negativity coming in these markets. The dollar we talked about, so going back here, bearish. Oh, the transports. Take a look at this now. Kind of dovetailing with this idea of bearishness setting in. If you go to the transports have a swing point low here, another one there. They came right down to it, big spike down, getting a little bounce. Assuming that bounce makes its way back up to these two swing point lows it's already broken, and then sets up an ABCD structure to get lower, it's going to threaten, and let me grab the weekly chart, it's going to threaten the swing point low that also is on the weekly. This is the transports. In other words, moving goods around, they're having a much harder time, and that's despite their central cost being much lower. That tells me there's not as much stuff that needs to be moved around. And at least the expectation is not there. Transports, Dow theory, transports can't make a new high, Dow does. That is what happened. It's a concern. And until this changes and we actually see new highs here, it's just one more indication that we have to be careful. Breaks on multiple time frames in the sectors should precede breaks on multiple time frames in the indexes. And we're getting close now on a couple of these. One of them's the transport. The other one is on the staples. Let me pull that one up. If we look at it, here's the consumer staples. Again, swing points, lows, three of them on this particular time frame, all at the same price. They're not that much lower. And if we pull up the weekly on it, you can see multiple swing points on the weeklies as well. If we start to get these breaks, right, this is going to be a big issue. It's just going to be more confirmation that this market really is struggling and is at best going to continue to struggle going forward. What's positive? Well, the trends, as we talked about, still higher. The other positive is that the European, the Chinese, the Japanese markets, they're almost all sitting at their highs. And of course, if you look at those three, what's common? Central bank intervention in all three of them. QE here, QE there, and basically central bank, quantitative easing, if you will, in China, just in a different form. They're still using conventional measures versus the unconventional, but they're still having to prod their market along. They've done a lot of changes to the market structure to pull capital into their markets. They're all sitting at highs. That's very positive. It's very hard for us to get a sell-off until this changes. And right now, that doesn't look like it's going to change. If I had to name one thing that makes me not so bearish, it's that. And it's that those countries, those markets, at least so far, they're basing at the highs, which says that there's the potential that they could still go higher. If that's the case, it's very hard for us to sell off in a deep way. The way we sell off in a deep way is that these markets start to pull back. Instead of holding their higher bases, they start to give them up. So that's definitely something we have to keep an eye on. Fundamentally positives, it's the same thing as last week, the zero interest rate policies, the QE. Although the Fed keeps telling us they're going to change that. Yellen's going to be speaking again this Thursday. She warned us again last week that is going to change. We had multiple Fed speakers say the same thing last week. It's almost as if they're going to keep prodding us that they're going to change that zero interest rate policy I don't know if they can, because if they press the dollar higher, we've already seen what issues it causes, but that still is a positive for most of the world. Fundamentally, the negatives, really, it's earnings, and it's also it's also not just earnings. It's also, and I should put this in here, it's also the economics. We have seen bad economics now for 7, 8 months, and if those, and we've got a slew of them this week. Right, it's the beginning of the month. We get a bunch of them at the beginning of the month. If those don't start turning, remember last year it was the weather. This year it's the dollar. Both of those, at least last year, that changed when the weather cleared up and economics got better. Is the economics going to get better this time? It's not a seasonal thing like weather. It's the dollar. Is the dollar going to get stronger? Well, as long as the Fed keeps talking about raising interest rates, the dollar isn't going to fall that much. And it's probably going to continue to put pressure and give companies excuses to make their earnings, it gives them an excuse to say, hey, I didn't earn as much. We know, as a matter of fact, that the majority of these companies have manufactured their earnings. It's not that they're growing sales, right? They're able to manufacture those numbers by borrowing cheap, buying back their shares, manipulating their PE ratios. That's not something you can do forever. And you can't do that if the interest rates are going to go against you, which it looks like they may. So what does that do? That forces you to readjust your books, create a little bit more, slop is what I call it, give you more room to wiggle around next quarter by blaming it on something this quarter. And I think this earnings season has the potential to be very negative. And if so, even though we're selling down coming into it, if it's very negative and we sell off more, that's a big wake-up call, because that's going to put pressure for the next 2 to 3 months on the whole market, just as it did this particular quarter. What do we watch for? Last week we were talking about the volatility would increase. It didn't much. We were talking about, will the bullish targets be reached? Not even close. We were talking about the double top on the NASDAQ. Well, it didn't even get to that point. Nothing that should have happened happened. And when it doesn't, again, neoclassical is all about what should happen doesn't happen. If it does, then the thought process is right and you can expect more. If it doesn't, it's a wake-up call that says, hey, it's not what you think it is. In other words, this bull market is not what you think it is. It should have gone higher, didn't. What are we going to see this week? I'm very curious to see if we get the flip-flop again. Do we turn around and buy all the cheap stuff, or the stuff that sold off last week, and sell all the stuff that went up? So in other words, commodities, dollar, all those things, they all flip around and go the other way again. Equities flip around and go the other way. I don't know if it'll work that way. That's the way they've been trading this thing. All I can see is that we've got a lot of up and down. It continues to be up and down, and we don't want to mess with it until it gets extended one way or the other. I don't know that we're extended to the downside yet, because I believe that range, if we look back, and let me pull up the S&P again, this we could say this is extended in this range, but is that really the range, or is the range really here again? Is it all the way down? We don't know yet. What we do know is that we're getting a lot of flop back and forth, and it's just not worth taking the risk to assume this is the low. What I would prefer to see is, I'd prefer to see it undercut this low, right, and then try to make a rally back up. We could buy that, put the stops up underneath it, right, and have a lot less risk, and then try to trade it back up into this area and sell it. That would be the ideal case. If it cuts it, flips around and holds it, and what I'm talking about is, if you look back over here, you get underneath it, right? You flip around, you go back up, and you get a nice spike back up. We have to wait, be patient, let a false move lead to a fast move, and try to catch that. I think that's where the best trades are going to be for the near term, at least the next month or two. And with earnings coming, anything you trade now really has to be a trade, and you have to be thinking a few days. There's no reason to be thinking anything longer than that at this particular point. If we look at the strongest index, and I haven't even shown these charts, so let's look at them. You got the same case here. It did undercut it, came back up. This is the strongest one. That's what you would expect to see in the strongest. If we look at the NDX came down, did the same thing. And then if we look in the Russell, which of course has been the strongest, the Russell came down and didn't even make it back to the lows. So we're kind of seeing it in the stronger ones. We're not seeing it in the weaker ones yet. What I'd like to see is it come back down, try it again, or just let it come down, straight down and test these lower lows here on the Russell, and on the S&P 500 actually get back into these big bars about halfway down. And I'm talking about this range right in here, something in this area. All right, so if the Russell and those came down to test their lows, and if this came down into this area somewhere in here and then came back, then that tells you that you've probably got a low in, and you can put your stops up underneath it and make the run for it somewhere in this area. So I just, at this point, I don't want to lose more money. And I think we have to, switch our thoughts away from trying to catch every little turn and putting a lot at risk for a little, and say, hey, I wanted to do a large false move, and then we'll try to catch the fast move in a short period of time where we have the advantage to our side. And so at this point, I'm just not interested in trying to chase these moves as aggressively as we have in the past, assuming that we're going to get bailed out no matter what. I just don't know how much longer that's going to continue, and it's a worrisome part from my perspective. Okay, so let's look at what else is coming. So if we pop over, get into the economics of it all, start of the new month, you get a lot of stuff. You've actually got an interesting case this week, because Friday's Good Friday. The markets are going to be closed on Friday. So if you look down here, there's nothing on Friday, but you do get the employment number on Friday. So you're not going to be able to trade it. That itself into the long weekend creates some pressure to square your books in front of this. But in front of this, you've got a lot of data, right? You've got manufacturing, PMI, you got Yellen speaking here Thursday morning, you've got all these manufacturing indexes, the flash PMIs, a lot of data. So this week looks to me that it's going to be very choppy. A lot of, potentially up and down moves within the week itself as this market tries to prepare not only for what's coming in, but what's going to come in on Friday with that employment number. Because remember, the big thing for the U.S. right now is the potential, this balance of when are rates going to go up. Nobody wants to get in front of that too long. The assumption is when those rates go up, we're going to get a sell-off. That's what the assumption is. Now, Yellen and the rest of them are trying to get this market to slowly sell down in front of that rate, right, so that they can raise that rate. I think the dollar is a big problem, though. I don't think they can do it. I think it's going to be hard to pull it off. And so the bottom line to me is that we got divergent markets, sectors, we got continued failures, we got this unsettled trading going into the earnings season, and then at the same time, we got most of the world near the highs. It just looks to me like it's going to be a lot of choppy up and down type trading over the next few weeks. And we just have to be careful and wait until we get situations that allow us to put on some exposure at what looks to be some sort of a false break, either topside or downside. And I believe we're finally at the point where we can think about trading short at the highs. And so we can start to think about, if this market comes back up into this level, we can actually short it on some sort of a false break. So you push up here, I grab my cursor again, you push up here potentially if it were, and you come up here and you get right to the highs, you go over them maybe and you fail, right? Then you can put your stops up here and short it. I think you can trade it both ways now. I'm not nearly as afraid anymore to try to short this market, given what I've seen so far this year and what my expectations are. And so, At some point here, that will be probably a trade that's on the table for us. Somehow it will set up, from some level, right? And and I guess the main takeaway before I go to the stocks themselves in the portfolio is breakouts are not working. And let's flip to the portfolio and we'll look at that together. So if we look at it, right, we can look at the first three are the best examples. All three of these were breakouts: Facebook, KeyBank, eBay. And if we look at each of these, so let's pop to the chart here, and we can start with let's start with Facebook. So here's Facebook, all right? Nice big run, nice big breakout, volume expanding. What happens? Gets up to some high, gets a big sell-off, just as the market does, comes back down, a little weak bounce. That high should have extended, right? Or at least it should have held higher and pushed higher. But what did we do? We go over, under on a weekly, right? Coming back in to do a retest regen immediately on Facebook. And if we look at it on the monthly, right, it still looks pretty good. I'm not, overly concerned about it, but it's not doing what it should do. And that's on Facebook. If we look at another one of the trades, KeyBank, same thing. KeyBank breaks out here, swing point high, breaks out here, swing point high, and look at it. The very next week, not only is it a takeaway bar, it's a double takeaway bar. I mean, it takes away not only that, but more, right? Total failure. eBay, same thing. It's got a breakout. eBay does on a breakout back here. This breakout in this area here, right, when we got into it back then, not only was it breakout there, it was a breakout on the weekly. eBay had been in on a monthly, had been in a total downturn for a long time. It can't hold the breakout, right? So everywhere we look, right, all of these are telling us, hey, breakouts aren't working, right? And if something isn't working, you have to quit thinking that way. Why is that important? Well, because these have worked for 3 years. Every time, right? If you bought a breakout and you just held it, you got bailed out. It's not that easy anymore. It's just not there. And that says, hey, you got to change your strategy. And I've got to change my strategy, and we should change it together, because those trades, they're not working as they should. If you're going to buy a breakout, you got to sell into that first push higher. If you're going to buy it, right, you got to sell into that first 2 to 3 bar extension and look for something else. And maybe the better trade is not even to mess with the breakouts, but wait for the retraces and buy the retraces. DOX, if we look at the strong ones now that we're holding, they're still doing okay. I mean, DOX holding up here at these levels. Strong stocks that have been strong, right, continue to be strong, even though there you get a lot of volatility. Look at NXPI, went as high as 108, came all the way back to 94 or so, 93. So it knocked 15 bucks off of this, right? So over 10% 4 days. Now it gets a nice little bounce. But again, the volatility is in these. ZLTQ, which we've made a bundle on. Earnings back here, makes that nice run right back up to test the top of the earnings, and then what does it do? Get slapped down. Actually bought some down here coming into this big bar. That bar, as it came into it, the volume's much less. I think this will get another bounce, but again, this is going to be volatile. Have to sell the bounces in all these. We can't just sit on them anymore. It's just the way the trade is, and we're just going to have to live with it. I've run way over my time here. I'm going to cut it short and let it go at that. It's a different market, folks. I can't stress it enough. We have to trade it different if we're going to make money. That's what we're up against. That's where we're going to have to go. Thanks. I will be talking to you as the week gets going. Thank you.